A temporary buy down paid by the seller basically funds an account that will hold all the dollars that are used to subsidize your payment for those first couple of years.
This is Las Vegas Real Estate Now with local real estate expert Harvey Blankfeld.
John, I really want to talk to you about ways that we're starting to see creative ways that I see builders doing this. I see other lenders doing it. Creative ways to help buyers keep their interest rates low.
Sure.
Tell us about the, I think it's called a 2-1 buy down or something like that.
Yeah, where we ended up, we brought back something old and made it new again. And this is what we call a temporary buy down. And what it is a temporary reduction to your permanent interest rate. So for possibly the first 2 years, maybe the first 3 years, your interest rate is artificially lowered away from where it would be, where you're paying something lower. So as you said, the 2-1 buy down basically says, let's pretend you have an interest rate of 6%. Well, for the first year, you start your payment as if your interest rate is 2% lower.
4%.
4% instead of 6%. And you pay that for 12 months. And then at the beginning of year 2, it rises to the second level, which is a 1% reduction. So now you're paying 5% for a year. And then eventually at year 3, you reach your permanent interest rate that doesn't ever go any higher, but now you're at the 6% that your loan would naturally have.
But it is paid for in advance. Usually, I mean, you might have someone, the buyer's not paying for this.
Yeah, the buyer's actually not allowed to pay for this.
Okay.
It must be paid through a credit through the seller. When you do permanent buy downs, when you're spending money on an interest rate to make it permanently lower, as soon as you replace that loan with a new loan, a new interest rate, any benefits from that buy down are lost to you, right? It no longer serves your benefit. That is not the case in a temporary buy down. A temporary buy down paid by the seller basically funds an account that will hold all the dollars that are used to subsidize your payment for those first couple of years. And so that account exists whether you refinance or not. And so if you did refinance a year from now, any dollars in that account get applied to the principal of your loan automatically all at once. And so none of it is wasted. We're not buying the rate down. We are subsidizing the payment for a specific number of payments. So 2 years, 24 payments, we're subsidizing that. And so those dollars sit it into account and slowly drip out the amount of money needed each month, month by month, until it's all used up. But effectively, you're using the seller's money to help pay that monthly payment for the first couple of years.
You've been listening to Las Vegas Real Estate Now. If you ever have a question about real estate or any of the other topics we cover, just call me off air or text me at 702-203-1165. You can also check us out on the web at lvrealestateradio.com or on our handle on social media at LV Real Estate Radio.